$1,000 of income. But then you have a Roth IRA. Everything else that comes from that will be tax-free. In your materials, there's a whole series of pros and cons and what factors one should be looking at. Tip number 6 for you is everyone in this room and every one of your clients should be running the numbers. My suspicion is 98% of you will reject that the conversion, but it's something you should analyze. It's something you should be analyzing on behalf of every client. Not only will probably 98% of you reject it, but of that 98%, there's going to be a very high percentage that is going to give you the opportunity to review beneficiary designation forms, make sure that those are current, and so the whole exercise will be worthwhile. A couple things with the Roth IRA. There's a special rule. If you do decide to convert in 2010, there's a special rule that allows you to defer the income tax for 2 years. So you can pay half the tax with your 2011 tax year and half the tax with your 2012 tax year instead of paying it in 2010. However, be mindful of the following. If you think income tax rates are going to go up in future years, then in that circumstance you might be better off paying the piper in 2010 at 2010 rates than to defer it into 2011 and 2012, where even though you get a deferral, you potentially have a higher income tax rate. Okay? So that is, I think, that is tip number 7. Tip number 8 is the mulligan. Okay? You can elect to do the conversion. You could do it in April of 2010. Take that $500,000 IRA, convert it to a Roth. Let's say in the summer the equity markets drop 20%. Your $500,000 IRA has now gone to $400,000. Doesn't sound like a very smart move then. What you can do is you can actually elect to reconvert back, and you have up until the time of filing your 2010 tax return. So you always have that opportunity for a mulligan. The mulligan is tip number 8. I just have a couple of comments on some things pending down in Washington presently that I think are critical for you and for your clients. There is a planning technique called a grantor retained annuity trust. If any of you are not familiar with that, I'd be happy to speak with you after my presentation. But what I want you to understand is that the House has already passed legislation that will place restrictions on these GRATs. Okay? The Sam Walton's family, Walmart, they came out with a planning idea called the zeroed out GRAT. What this legislation is aimed at is to eliminate short-term GRATs. You would have to have at least a 10-year GRAT. Again, here's the planning opportunity. House has passed it, is now with Senate Finance. Senate Finance hasn't even begun a markup of the bill. So here's your window of opportunity. If you want to do a short-term GRAT, get it done before it actually becomes the law. So you have that opportunity. That's tip number 9. And my final tip of the morning is I just want you to be aware that about 2 weeks ago, the Foreign Account Tax Compliance Act, the FATCA, passed here. What does that mean? It placed severe restrictions, disclosure requirements on foreign financial institutions whereby they have an obligation to report back to the U.S. any foreign accounts being maintained in Europe or internationally. There's been a huge pushback from these foreign financial institutions, threats that they won't operate in the U.S. markets, they won't take on U.S. investors, because the IRS, their hammer is a 30% withholding tax. My point to you this morning is simply that if you have any clients that have foreign accounts, this is the time for them to be reporting. The penalties for an individual who fails to report a foreign account, $100,000. Extremely draconian. That's it. I hope I did it in 10 minutes, and thank you all for coming.
Thank you, Kevin. Always beware when Congress says they're here to help you. Our next speaker is going to be Steve Eisenstein, who's going to update us on a new era at the DEP, another three initials that always warm the hearts of business people. Steve obviously does a lot of environmental law, and Steve, I'll turn it over to you.
A new era, the latest of many at DEP. Boon or bane, too early to tell. The topic I want to talk about is the new Site Remediation Reform Act. This is an extremely high-level overview. When I say that, realize I've got 12 slides here to go through. When DEP presented this to the regulated community, when the act came out, that presentation was 361 slides. So this is hitting the high points. The Site Remediation Reform Act is a new regulatory scheme that basically replaces ISRA. The hot rumor right now with DEP is that they are going to repeal ISRA. We don't know that yet, but that's what they're talking about. There is an annual fee associated with your remediation, no oversight costs. People are used to getting billed by DEP for the work that DEP does. Now there's going to be a complicated formula depending on how much contamination you have, where it is, what it affects, multipliers, and everything else. Nobody knows how much it's going to cost until they start doing it. LSRP, Licensed Site Remediation Professional. That is the key to the new system. The LSRP replaces DEP as an oversight mechanism. The LSRP is a private environmental consultant who is licensed by a board. The LSRP board is a 13-member board that is in DEP but not of DEP. They're an independent board. They oversee the LSRP. DEP has no authority over the LSRP, but DEP oversees the site. So there's potential for some great dynamic conflict. The LSRP has a strict code of ethics. This is one of the danger points. Ethics are always good, but when they are a very strict code of ethics with no outs in them, people get nervous. And the LSRP has a license that can be revoked if they violate the strict code of ethics and they're out of business. What that means is the LSRP, when he comes to your site and investigates it, finds contamination, he now has an obligation to report the contamination to DEP. You no longer have the option to sit on it or tell him not to report. If you tell him not to report, he's going to tell DEP that you told him not to report. And that's a situation you don't really want to be in. He's going to tell DEP when he's hired, when he's fired, and he's got to tell DEP if you reject his recommendations. If he makes a recommendation to you on how to clean up a site or what you have to clean up, and you say, no, I can't afford to do that, do it later, he's going to tell DEP that. If he doesn't, he can lose his license. The program will be fully effective in 2012. All sites must have LSRPs by 2012, new and old. If you have a site now that you're cleaning up and you haven't finished cleaning it up, if you don't finish it by 2012, you're going to have to switch over to the program. The use at that time will be mandatory. It's already mandatory for new sites. Obligation to remediate, Spill Act applies. The Spill Act now applies to all contaminated sites. If you find contamination on your site, you are now legally obligated to tell DEP and clean it up. There are no more excuses. There are no exemptions. You have contamination. You are going to clean it up. The MOA program, which a lot of people have been operating under, Memorandum of Agreement, where you can enter into a contract with DEP and to remediate at some later date, no longer exists. You're going to clean up, you're going to clean up under this new program. DEP is going to establish mandatory timeframes for key phases. There are going to be two kinds of timeframes, regulatory and mandatory, and violation of them has very strict penalties. if you violate a mandatory